what if you started your day investing in yourself? You're not investing money, you're investing time. And there was really 3 E's that we started with. A little exercise, right? Get the body in motion. The second E was education. Where can you kind of develop the most important skills, whether those skills around money and cash flow like we're talking about here, or maybe it's emotional intelligence, or maybe it's marketing, or maybe it's speaking skills, but you're reading something that helps you to put your value out there in the world. And then the third thing, and reading or listening or however it might be. And the third E was enlightenment, which was more about a spiritual component, a gratitude component, or a component for space.
He says, given the recent market volatility and my newfound desire to reclaim my wealth that's trapped in a former employer's 401k, I felt now may be the time to execute on several strategies. Is now a good time for a cash out given the drop in value will hopefully trigger a lower taxable event. The account is actually a 401k tied to a brokerage account, which let's pause right there. What's the difference between a 401k and one that's tied to a brokerage account?
Well, I mean, he just probably, it depends on our investment options more than anything, right?
Okay.
Like self-directed IRAs, you might be able to invest in real estate or land or businesses, where most of the time in brokerages, you're limited to stocks, bonds, mutual funds, those types of things.
Okay. So the account is actually a 401k tied to a brokerage account where I have a stock position in specific companies. Is there a way to maintain these positions and convert the account to a traditional brokerage account, hopefully offsetting some tax given the current market volatility?
So
is
the
there
type
a better
of brokerage
way?
account he has, by the way, allows for stock buying, which is a little bit more broad than most employer-based 401ks that are, you have a few funds to choose from. So that's good. So let's talk about several factors here.
Okay.
One, if we look at the year 2000 to 2002, we had, 3 straight down years in the stock market. Then we saw from 2008 to 2010, 3 straight down years in the market. I started to speak up about we were having a very long period of time between recessions. We were getting into a consumeristic kind of over leveraging, a lot of borrowing, more defaults. And we were doing a lot of things where you'd see interest rates, lower. You'd see, different patchwork to kind of keep things going. And we went about the longest time we had ever gone without any recessionary type of thing. So we were on a pretty fragile system when the coronavirus hit.
Yeah.
Right. And so, yes, we're seeing pretty major swings because hedge funds sold positions, and that was a large movement in the market of a sell-off. We watched, Wall Street multiple times halt trading, and we just see that people are heavily concerned because not only are we dealing with the economic frailty that already existed, but now we're dealing with the fact that people are quarantined, they're not going out, and so that's exacerbating the problem and exaggerating it to a large degree because it's really hard for some people to make money in this type of world, right? Now, maybe if you're selling toilet paper, you're crushing it, apparently. But for everybody else, there's a lot of people that are kind of struggling. So this is moving a little bit more swiftly because of that, right? It wouldn't have had kind of this sharp downturn, just like we saw because of a lot of what was happening with banks in 2008. You saw it happen pretty swiftly. But I don't look at this as a short-term situation. Now nobody can predict how long anything lasts. There's too many variables: consumer confidence, interest rate changes, government flooding money into the system, how long it takes before people are out and about and purchasing again. And so there's a lot of factors. But what I would be really careful with is thinking that, let's just ride the storm like a lot of people are being told. Like, we're in it for the long haul, or the market's on sale. I know people that were like, hey, is it a good time to buy? I'm like, no. And they went and bought anyway. Now, I'm not a registered investment advisor anymore. I was at one time, had my Series 65, 663, all those kind of series. So you have to ask an investment advisor for the very specific advice, especially get it on the one-on-one side. Unfortunately, a lot of them are just going to tell you to buy more. Just keep adding more funds. But what I like that he's bringing up is there's going to be a lot of people that pay a lower tax rate this year than normal because there's going to be a lower earning. I know people are getting, loss of jobs right now or cut 15% on their salary. So if you were going to cash out, yes, there's a 10% penalty for cashing out, but that's one time 10% if you're under 59.5. I look at it like if I were to give you a loan right now and I just charge you 10% for the life of the loan, not a bad interest rate on that loan if it was a 30-year loan. Right? It's like 1/3% per year if we look at it that way. So I wouldn't mind considering that. For me, if it was me, I'd be fine paying the penalty. I'd be fine, making that change. You could even move to a Roth conversion as a one-time thing, right? So that you could still have some tax-free growth off of some money like that. You could just cash out and have even more control than that. Or as he said, roll that over to another type of a brokerage type of IRA because it's a former employer. But I think that everybody should consider how much further down would it have to go for you to just be like, this is absolutely unacceptable, and consider a trailing stop loss. Now, the trailing part probably doesn't matter as much because it's mostly going down. Trailing is usually when it's going up. If it goes up by a certain percentage, it still follows it. But it says after a certain percentage drop, it automatically sells.
So even at this point in the market, like you would encourage someone to put on a trailing stop loss?
Well, I still think that we've got
a ways to go down. That's the tricky part when people are having
businesses aren't going to make it, Amanda. They're just not going to make it through.
So unfortunate.
It's frustrating, right? It's sad. Like I want to be an advocate
small
to
family
help them
business.
out, right? Yeah. But there's going to be other businesses that don't make it because they were already holding on.
Yeah.
So we have to really take that into consideration and just even question whether, when we're investing in the stock market, whether we have the stomach for that level of volatility. Right. Because this isn't unprecedented. We can go back to the 80s with Black Monday. We could go, to the Great Depression and what happened during that time. The Great Recession of 2008. Like these types of things happen. And I just did a video that we'll make sure at the end to let people know about, because I talk about what happens when a business goes out and how it makes us feel like we got better returns than we actually did because of the way they calculate it. That's really frustrating. And that a lot of the return that we hear about in the market, because it really hasn't done amazing since the year 2000. I mean, it's like a 6% return. People are still quoting these old returns of 8 to 10%, which really got boosted up because of the 90s. And so we're kind of with old philosophies doing new things or doing the same things. And the new philosophies are actually hurting us by just handing our money over, And so I like the questions he's asking. I think they're really good questions of what do you really want to do? Is now the year that you go, okay, I'm going to pay less tax. Maybe this is the time to get access to my money, or move to a self-directed. Really you can roll that over to a self-directed. There's no tax upon that rollover, right? It just moves to a different type. And it might be, if you move it to a Roth, there would be tax. And if you pay it out of the account, that could create a penalty. Or if you pay it out of your pocket, there wouldn't be, but that could start to harm someone's liquidity. So these are some of the considerations. I would question the notion of retirement plan in general. I think retirement plans are hurting people's retirement. Let's even go deeper than that. Maybe it's time to stop thinking about retirement for a while. We've got major problems. We really require major solutions. And the way that we get through this is through serving each other, through supporting each other, through exchanging. And this notion of retirement came during the industrial age, where people worked hardcore physical labor jobs. People were dying young. Like even when Social Security came out, people weren't living much longer past that. The age of what people are living to now, even though it's gone down a little bit in the last couple of years, has extended quite a bit over the industrial age. And so maybe rather than retiring, we start finding work that is meaningful. We start finding work that is rewarding. We find work that is rich. And it's not easy to find those careers, but if you're willing to do it, you might redefine that first and foremost. Second is retirement plans are all accumulation based. They're all deferral,
kind of frightening.
Right? Why not focus on cash flow? Because cash flow lets you know whether something's going wrong or not. It helps you sustain during these times when things aren't going well, if there's still cash flow coming in. It's the lifeblood of things. And when we don't have cash flow, we have to sell things at a discount. And that's where people are now struggling and kind of going back and forth of like, do I leave it in and hope that it recovers, or do I sell it? Only they can answer that based upon who they are.
Yeah, and what I'm hearing you say too is that it's never too late to find out where you can add value and contribute and be innovative and think creatively and outside of the box. Like sometimes I think we get into a certain like stuckness where it's like, it's just beyond me, or I'm too old, or my situation doesn't allow. But this is prime time to begin being a problem solver, thinking creatively about how you can find solutions for yourself, your family, your community, and go about things differently than we have in the past.
It's time to learn a really difficult lesson. And the lesson is that we've got to be responsible for our financial future.
Yeah.
That we can't rely on others and hope that they're going to just take care of us, right?
Right.
Whether that's the government and Social Security, because there's no money in Social Security. It's all been borrowed out the day that it gets in there.
Yeah.
corporations with pensions, we watch them fail miserably. And so that's another place that can't be relied upon. Wall Street, we watch what happens there consistently. And the U.S. Department of Labor says 95% of the time people cannot be economically independent at age 65, even with these multiple factors and efforts. So the responsibility could come to this. This is where I think we can all help each other out, is we could actually start looking at being more active with our investing. And this would be one major place, buying small businesses. Those small businesses are on a discount already. They're going to get in a deeper discount. And there's people that can come in and actually see those businesses through, where that person that's maybe been working in for 30 or 40 years is exhausted, tired, doesn't have new solutions. They've lost that innovation and that human ingenuity. And because there is infrastructure and there are employees there. And I think people are going to have a higher degree of gratitude now than they did before for what they do have. And if they could still have that opportunity to work, we had a workforce that 60% of them were disengaged. I mean, so if we thought value and you're buying smaller businesses, the SBA's lending on those small businesses, you might be able to get access to your funds to buy a business like that. And then you can actually influence the outcome of that income and focus on cash flow. So I know that not everybody's built for that, but hey, why don't we start getting educated on it during this downtime? What does it look like? How would you do it? The people that I know that have done that are some of the most successful people that are out there. Just had one of my friends that I think he owns 10 businesses now, all complementing the main business that he has, and they all coordinate, and he invests in people that he really believes in, and then he partners with them. And I've just seen he's got an amazing lifestyle, and he just said, hey, I've got someone that's looking to sell a business in the financial space. I'm like, great, please get us information. And right before we went to record, he sent me some of the information. I sent it over to my partners. So let's see what we can do to help each other out. Let's take an active role with our investing. And I like these types of questions because I think that we can learn the lessons, and most people are ignoring them when times just feel really good. We're too busy.
Oh, it's so easy, like for it to be out of sight, out of mind. And I think just being on your team for the last 2.5 years, I've heard you talk about 401ks for a long time, even before I knew you and worked with you. But it's just, I always am learning more. And there's like these little nuggets of, oh, I didn't know that was involved. Like the conversation that you referenced earlier today, but also you made another video was about how the hedge funds are selling. And I was like,
options, derivatives, and those types of things.
And really most people don't know that that's impacting their 401k.
84% of the returns in the market get made by 10% of the investors.
Oh, that's so tragic.
Companies go out of business and then they're zeroed out on whoever was invested in them at that time, but then they just replace them in the S&P 500 or the Dow, and then they just take the new company and what they're getting and show that as the future return, but that's not the actual return for someone who already had money. That feels so shady to me. It's just that math and money are not the same thing, and people don't really get informed on this because we're told to set it and forget it. Invest early, often, and always. Dollar cost average. We're in it for the long haul. High risk equals high return. It takes money to make money. This is a book I wrote in 2008 called Killing Sacred Cows, and people can grab that 44222 if they text that number and put wealthier in the subject line. They can download that book on me, or they can go to wealthfactory.com/megakit, MEGAKIT, and they can download full of
resources.
And then my other book, What Would the Rockefellers Do? Everybody that's followed that advice is texting and emailing because they're not losing money on the market downturn right now. They're not losing anything, and they have access to that cash without a 10% penalty. And at this point, it's outperformed the market for the last 20 years. I mean, holy cow. Like I feel really passionate about this, and I come from a place of compassion. Like, it's not like people are trying to do the wrong things. It's not like people want to be in these situations. They're just getting whatever advice they've been given and doing the best that they can. And I've got to do better to get this information out. I mean, this is my third time filming this week, multiple videos. So please keep the questions coming at askthemoneynerds.com. Stoba will ask them. We'll have a little banter back and forth, but you've got to decide, when is enough enough? What can you do to take responsibility of your financial life? How can you learn how to create cash flow rather than just accumulate? Don't just defer, but really start looking at why would this work? And now is the time to build up some cash, to pay off some loans, and to figure out in yourself where you have the greatest capabilities, competencies, and abilities that you can bring to deliver value to the world, because if you bring that value, that's what's going to lead to future wealth.
What should I do with my whole life policy or use it for, and can I use it to fund other investments?
The answer is absolutely you can use it to fund other investments. The cash that is there, you have a few options. The first one I don't really recommend. You can withdraw the money. If you withdraw the money, you might not have the opportunity to put that money back in. I like to borrow the money, which you don't go to a bank. The insurance company goes, well, you have cash here as collateral. We'll give you a loan against that. We'll charge you an interest rate. You'll continue to earn an interest rate. And then you can choose to do with that money whatever you will. Be careful not to dive in too early. Be careful not to jump the gun, though. Because in there, maybe you're getting 4 or 5% without risk, without worrying about what's happening in the stock market. And I know people that are diving into the stock market now, which I'm like, well, might be a little premature. Now, maybe they really know what they're doing and they're picking the right types of stocks, but I think a lot of people are doing it based upon emotion. So yes, you can access the money, but be careful because you might be speculating with the money and taking it out of a guaranteed scenario.
Yeah. So don't take that money, invest it into something else where you could lose more than you could have. Actually, just to do this comparison, market's losing a lot of money right now, up 10% yesterday. How much what's the maximum you could have lost in a whole life policy?
None, because you have a minimum guarantee. Some companies might be 3.5%, 4.5%. That's obviously after expenses. That's on whatever amounts in the account, but that's guaranteed. So it doesn't go down.
Okay.
It's there and it's available.
So being very specific, if you're going to take that money out, you need to know and be very clear on what your potential to make reinvesting it into something else.
Right. And for me, if something's not doing like 9 or 10%, it's not worth it, because if I'm going to pull it out and put it in a taxable environment, maybe like one of my policies has done 5.32% after all expenses. But let's add in, I didn't pay tax on that, and I can still get to that or access that without tax. At the top tax bracket, that could look like, maybe I got to earn 9% or more. And what if there's fees on these other investments or things like that? So I'm really cautious. I have not tapped into my cash as of the time of this filming. I'm still waiting, seeing what comes available, knowing there's going to be plenty of opportunity for those that are patient, not patient like 10 years from now or 20 years from now, patient like 6 months from now, 12 months, 2 years from now. There's going to be a completely different marketplace and world because everyone's being trained to accumulate. And accumulation is all about net worth. And the problem with net worth, you could have a $10 million net worth, but if there's no cash flow, you might be on dangerous grounds where you have to liquidate that at a discount just to cover your basis, right?
Yeah.
So I like cash flow investing, and I like capitalizing when people need to get liquid because they've been overemphasizing net worth. Emphasize cash flow, because then when there's times like this, you can tell if something's going wrong, if it's not working, and if it lowers or if it goes away, you're like, okay, I got to address this. I know people that in other recessions, they didn't even open their 401k statements because they didn't want to get the bad news. Now, I can understand that. But the reality is, if we don't take responsibility, then it really becomes a problematic situation long term. And focus on cash flow. Be careful with what you invest in. Make sure it's part of something you know and understand and you have expertise. Don't just jump into something because of speculation or you heard someone else was doing it or you think that now's the right time. Because the reality is we don't know what's going to happen. It's, we just know that people are in concerned state. There's a bit of panic in other states and people are heavily concerned about their money.
So if people are out there that are listening right now, they don't have a whole life, they're, maybe they're interested, what is this cash flow banking thing all about? What's a good place for them to start?
Well, a good place for them to start is, even before considering this, having some savings. Just get in the habit of paying yourself first, setting some money aside. My recommendation is 18%, which is really hard for most people. But realize the way that we get to 18% is save on tax, save on interest by restructuring loans and refinancing, right? Or reallocating underperforming assets to pay off higher interest rate loans, or renegotiating to better interest rates, or finding where there's hidden fees or commissions within investments and put that money back in your pocket, or seeing if there's any insurance policies that you don't have the right structure, like too low of deductibles that create higher premiums, or not coordinating policies and getting multi-policy discounts. We're looking for where are there dollars that are just being lost, slipping through the cracks. Let's find that money, put it into savings. And when you've got a little bit of savings, you can just automatically start moving the savings over into these policies, but they have to be designed right. Too many companies take years to ever get cash in there.
Yeah.
You can't wait years. Most people don't have that kind of liquidity. You want to have cash value showing up in the first year, which means lower commission policies, something called PUA, paid up additions. So you're overfunding beyond the base. The base is where it's mostly commissionable, right? Not saying mostly commissionable to every dollar, but it's like you have commissions that are the highest percentage on that. Overfunding has much lower, if any, commissions depending on the company. And so you start to see more fuel in the cash value.
Yeah.
And you want to look for mutual companies that are, worth tens and hundreds of billions of dollars or even $1 trillion. You want to look because they're privately owned and not publicly traded, so they're not splitting up their proceeds between stockholders and policyholders. You want to look for that early cash value, flexibility for that PUA. Only A ratings across the board because, B ratings are concerning to me, knowing that there's pressures to rate companies pretty well.
Yeah. And I know, as someone that opened a policy recently, one of the things that I noticed, at least from properly designed policies, is your cash value was almost equivalent to your contributions by year 3 or year 4, correct?
Mm-hmm. Yeah. I mean, I had some that were a little earlier, some that were a little later, because my first policy at $50 a month was just a base premium.
Yeah.
My second policy at $262 per month was still a decent amount of base, not fully overfunded. Mm-hmm. But then later on, I ended up doing policies that I put as much as I could without changing the tax consequence. There's something called a MEC, a modified endowment contract. If you put too much in the policy, you lose some of the advantages. One is called FIFO, where you can pull your money out that you put in first and not pay tax because it's a return of your premium. But if you put too much, they say, no, we'll give you your money back. We'll give you your money back last. We're going to give you your interest first. So that's all taxable. So it becomes more tax deferred and less tax advantage from a tax-free standpoint. Mm-hmm. So there's parameters there where there's a thing called the 7-pay test where you could put in maximum funding for 7 years. Mm-hmm. But if you go above that, you could compromise the tax advantages. So cashflowbanking.com has a lot of cool resources. But I think the question is really, yes, you can use your cash value. Mm-hmm. Just make sure you're using it for the right things. If you have a 22% credit card, cash value would be a great place to tap in and pay that off.
Yeah.
But make sure you've got enough staying power, enough liquidity, enough cash on the sidelines to handle, a disruption in your business or a disruption in employment or a health challenge or a family challenge. Too many people are running too lean, too thin on that, and they don't have the ability with one crisis or one issue to weather that storm.
Yeah, and you mentioned it a little bit ago too, that your first policy was worth $50, right? So it's not this, you don't need thousands of dollars to start one of these. You can start it pretty much at any level.
Right. So in What Would the Rockefellers Do? Mm-hmm. When I wrote, I'm like, you might take some zeros off the end of this because they're worth so much money, but there's certain principles that we could learn from. And they got to do things called private placement life insurance or premium financing where the bank finances it and they don't have to come up with the cash. But what I wanted to do in that book is say, if you're not that wealthy, which the mass majority of people are not, and I didn't start that way, what can you do to design it as closely as possible? What can you do to create the closest advantage to what they had with, with a degree of, it's not exact, but it's close.
Yeah.
So yes, you can use your cash, you can build the cash, you can start, you don't have to scrimp and sacrifice. You could find if you're overpaying tax, or you can refinance and get your lower interest rates. It's about finding those dollars versus ruining your lifestyle, trying to build a better future at the expense of your quality of life.
Totally. I think that's really amazing. I was going to kind of just cue you up to summarize this. The Rockefellers are a great case study on this too. But I also found one of the most intriguing parts is most banks and other companies where they put their assets. It's not in the market. It's not in other things. They're putting it in these policies
bank-owned life
too,
insurance. Right? You have corporate-owned life insurance. You've got banks put a percentage of their reserves in these types of things. But once again, cash heavy. They're getting more cash available because of the way it's designed, the way that it's purchased.
Let me just get to quickly through how the framework works to create economic independence so we could dispel this notion of, investing for retirement, because entrepreneurs, when they turn age 65, 92% of them could not stop working and still cover their expenses. It just doesn't happen. Why? Because it's an antiquated, problematic model where you're being taught to accumulate through deferral, through sacrifice, and through saving. And budgeting sucks. That's why my next book's called Budgeting Sucks, is because no one wants to budget unless they're a weirdo. There's some weirdos in here that like to budget, right? But for the most part, we don't love budgeting. And the reason is it doesn't actually work because it puts you in a scarcity mindset and has you think about constraint. So here's the alternative to budgeting, because as I give you these strategies that are going to put money in your pocket, this is where I want you to capture it. So if there's one action you take from this talk, this next action is it. So be ready to take notes, all right? And it has nothing to do with my company. You just go to wherever you're currently working. The key is you set up a wealth capture account. It's a separate account than your business checking and your personal checking. What I found is businesses have insatiable appetites. We can always find stagnant money, can find a place to go in a business if it sits there for too long. On the personal side, some of you might be deep savers, but some of you might be spenders, or some of you might, be addicted to really nice lifestyles, because what I found is a luxury once enjoyed becomes a necessity. I grew up in a coal mining town. we stayed in, motels, and now I stay at boutique places, and it's like, that's a lot different price range. And I asked my wife, I said, hey, if we ever went broke, what would you miss most? She goes, where we stay, those damn hotels. Because, when we first were together, I read Millionaire Next Door. I was going to pinch my way to wealth and save every penny, to the point where she was like, this was a big mistake. I think she thought that. She may have said it to family and friends. She was probably not willing to admit it to me, but thank God I kind of had an epiphany and transferred into the concept of more thinking abundantly and thinking about exchange and thinking about value creation and thinking about enjoying life along the way and understanding that you are your greatest asset. Not a stock, not a bond, not a piece of real estate. So if you don't take good care of yourself, you don't have very much to give. And if you're constantly in constraint and restraint, then you don't learn how to invest, because every dollar becomes a cost to people in the scarcity mindset instead of dollars that become an investment. An investment, you put $1 in something, more than $1 comes out. How much should you budget for that? Infinite, until it doesn't perform anymore. That's why budgeting is a stupid ass notion, and I'm about to dispel it for all of you so that you can live a freer life. Would that be worth coming? Okay, good. Now I'm hyping it up like a son of a bitch. I better deliver here. So, all right. So here's the deal. You set up a separate account, and I should make this seem like it's more magical and more difficult. It's so easy, but so profound. You set up a separate account at wherever you're banking. You need to make sure it has a sweep relationship, S-W-E-E-P, not sweet, a sweep relationship, where you can automatically sweep money into this account. So when you go to pay yourself, you take money from your business and you pay yourself personally, which if you're not doing, what the hell's wrong with you? We need to talk, because we'll get that money back from the government so you can start paying yourself more. But when you go to pay yourself, you just pay yourself first, right? Before you pay bills, before it goes to lifestyle, you take a percentage off the top. My recommended percentage is 18%. Now there's a reason for that 18%. 3% because I think taxes are going to increase. 3% for planned obsolescence because I just bought a house not that long ago and our stupid Viking dishwasher doesn't wash dishes apparently. I literally think there's Vikings in there licking the dishes, it is just, so we had to get a new, that's called planned obsolescence. You just have to replace stuff over time, right? Another 3% for technological change. Because even over by the rescue mission over here, there's still homeless people with cell phones. I mean, it's amazing. Technology changes our world, and there's certain things you're going to start to acquire that don't even exist today. Another 3% is for inflation. And that's probably low, but I'm just saying we got to be able to handle the fact that our dollars erode over time and our purchasing power goes down. Another 3% for one of my favorite things, which is propensity to consume, which means a luxury once enjoyed becomes a necessity. We just like to buy nicer things over time, hopefully. Hopefully we continue to increase our lifestyle. And the last 3% will probably be your favorite, which is simply you set up a second account. So you have two accounts you're going to set up. Your wealth capture account and your living wealthy account. Wealth capture, all 18% off the top goes there. Melinda, you've been doing this for a year now, right? Yes. Right, so she could tell you. Yeah, so I taught her this a year ago. She's been doing it for a year. Working? Yes. Absolutely. So I even answered for you. Is it working? Yes, it is. Yes. So, I probably should let you answer. All right. So this living wealthy account is you just take 1/6 of what you pay into the wealth capture and you put it in your living wealthy account. And this is the rule. Guilt-free spending. That's your reward for paying yourself first, that you get to spend that on whatever you want. Mine is probably heroin. I mean, maybe like psychedelics and stuff are fine, but heroin, I don't know. I just don't know. I haven't been convinced that could be a good thing. But yeah, what do you want to spend it on? You just treat and reward yourself with no guilt. Guilt-free spending, all right? You pay yourself first. Now, if you feel like 18% is hard to get to, that's where we're going to next. I'm going to show you how to get there. I just want you to set up this account, because if you don't set up the account, here's what happens. Parkinson's law kicks in. Parkinson's law states that when you have an increase in your income, if you don't have an infrastructure to capture that increase, within 3 to 6 months, your expenses will rise to meet or they'll actually exceed that increase. Have you ever met that person making more money now than ever before in their life, in more trouble than they've ever been in their life? Sometimes entrepreneurs spend optimism. They have a great month, and they extrapolate that as their income for the rest of their life, and that's just going to keep going up. And then all of a sudden, a logarithm changes, or something happens. There's a merchant account goes out, or they hold your money. I mean, there's a number of things. An employee embezzles. I mean, we are in store in our life for financial surprises. We just don't know when or how severe. So be careful not to spend optimism. But here's the good news: if you pay yourself 18%, then just once a month, find an accountability partner. It could be an accountant, it could be a spouse. You just have one person you meet with once a month to look and say, with the rest of the money, did I stay in bounds? I didn't borrow to spend, did I? I didn't spend more than what I made, did I? And if you did, that's all you got to do to eliminate budgeting. All right? Pay yourself first, and then make sure you stay in bounds.
What are the best daily money habits or routines to implement for improved productivity and improving cash flow?
Okay, let's do this.
Let's do it.
So look, I remember discovering something that we called the producer power hour. And our definition of producer was to produce more in the world than we consume, right?
Yes.
So you're adding something, you're adding value.
Mm-hmm.
And then the power hour was, what if you started your day investing in yourself? Mm-hmm. You're not investing money, you're investing time. And there was really 3 E's that we started with. A little exercise, right? Get the body in motion. Mm-hmm. The second E was education. Where can you kind of develop the most important skills, whether those skills around money and cash flow like we're talking about here, or maybe it's emotional intelligence, or maybe it's marketing, or maybe it's speaking skills, but you're reading something that helps you to put your value out there in the world. And then the third thing, reading or listening or however it might be. And the third E was enlightenment, which was more about a spiritual component, a gratitude component, or a component for space, because there's so much noise in the world. We're just constantly bombarded with things, and I'm noisy. I get it, and if you had this space to actually listen to yourself, to tune into that intuition, right? So that could be just quiet time to think. That could be meditation. That could be prayer. But starting your day this way was like putting on an armor of abundance so that you could show up the best version of who you are. And even though you take an hour, and I don't care if it's an hour, it could be 10 minutes, progress over perfection.
Start somewhere.
Right. Then the rest of the day is transformed, where you're bringing a better energy to it, where you're living your life with more intention, where you're developing the most important part of who you are. Right. And I think purpose, there's a lot of activities around finding it. But I think that starting your day this way is one of the best ways to discover that purpose, because I can't look at someone and tell them what their purpose is.
Right.
But I think that there's flashes in our life, right? Just moments. And if we're too busy doing and not getting any time to understand our being, then we miss out on what's available to us.
Yeah, the power hour is a recognition that who I am is valuable in itself, and that I can, when I invest in myself and I choose myself before I start my day, before I invest in anybody else's vision or mission or anything like that, that I am saying everything that I am and what I come to the table with is important.
Right. So let's put this in terms of money. So if you're doing a daily power hour, whether that's 5 days a week or 7 days a week, you just start your day that way. You can say maybe Monday that when you're doing the education side, you can implement something I call mindful cash management. So mindful cash management begins with the 4 types of expenses. So there's 4 types. The first one is destructive. So anything that leads towards debt, anything that's leading towards addiction, any of the things that you don't have control over or you're borrowing to consume, we want to eliminate those types of expenses. So if you look and you go, I've been paying for this thing for months and I've never used it, and it's something like Microsoft Word, I try to put that on my iPad, but it doesn't work without the internet because they want me to pay monthly. So I'm like, cool, I'll just use my computer instead of my iPad. Really small expense, $6 a month, but that would be an example. Slightly destructive.
And so many companies are moving to the subscription model, which is great and convenient in some ways, but sometimes we forget that we've actually subscribed to a service.
And we're not getting value from it.
And we're not getting value from it. So just taking an assessment of where am I investing money on an ongoing basis that's not necessary.
So that's a small way to improve cash flow. The second is our lifestyle expenses. And this is where having that weekly check-in, just to say, hey, where's my money going, right? What am I paying for? And is it giving me utility? Do I enjoy it? Like there's certain things that are almost like a must to live, but there's other lifestyle expenses that are kind of our choice. It's luxuries that we enjoy. It's, the things that we spend our money on that we go, hey, that has plenty of utility. We're just making sure that weekly you're not spending more than what comes in. Then the third type of expense is a protective expense. It's anything from building up your liquidity and savings to having insurances that transfer risk to, if you're a business owner, setting up the right corporations, or education is a huge part of your protective expenses, because the more knowledgeable you are, the better you can be at managing and mitigating risk, right? Simply, the protective expenses are usually something that's a bit negligent for people because nobody wakes up in the morning excited to address these things. The fourth one is a productive expense. Where can you add $1 in your life and have more than $1 come out the other side? Maybe it's investing in your skills and abilities. Maybe it's investing in marketing. Maybe it's investing in, just simple knowledge that you go, okay, I now know better what to do to monetize who I am and what I'm about and reach more people or more deeply impact the people that I'm reaching.
Yeah.
But by differentiating the 4 expenses, this isn't about budgeting. It's about mindfulness, right? So if you can pay yourself first, so it's just an automation. Every time you make a deposit in the bank, there's a separate account that has an automatic percentage go. You don't even have to think about it. It just sweeps over there. You're like, cool. Now everything else that's left over is mine to spend how I want. And so this is how we start to manage cash flow. And then you're just looking at, can I eliminate any destructive expenses? Are there any lifestyle expenses that need to be managed and maybe I can wait on because they're not that important and they're taking away from where I want to go? Protective expenses, I need to address that so that my money's not just wiped out with one financial surprise. And then productive expenses, where can you really increase those, right? So this is an important part of cash flow. Now, in all these types of expenses, I think it's important to really look at where can you find money that's rightfully yours, right? And that's the 4 I's.
Yep.
The IRS. Are you tipping the government? Let's stop doing that.
Absolutely.
Interest. Are you overpaying on your interest because you haven't refinanced or restructured your loans or renegotiated your interest rates? Investments. Are there any underperforming investments that could cash out and pay off the loans? Are there any investments that have hidden fees or commissions? And if you can get a little bit of financial detective work to figure that out, you can keep more of your money. And is there a way to protect the downside? And the 4th I is insurance. Are there duplicate coverages? Are there improper structure? Can you raise deductibles so that you just cover the basic things on your own and then have the insurance kick in for the more catastrophic type of events? So this is part of, your power hour is on Mondays. You just look and say, okay, where am I at paying myself first? With the money that's left over, I didn't go out of bounds. I didn't spend more than what was left over, right? Because I just got too excited and bought something. But if we borrow to consume, that leads to debt. That harms cash flow. So part of the money habits could be you could pick a day where you're like, that's my money day for education. So mindful cash management on that day, and you listen to one of these YouTube videos, or you pick up one of my books, or something like that, and you're just increasing your education because we aren't born with a money manual. We get money before we've probably ever read anything. And unfortunately, a lot of what we read around money, and look, I've been part of this problem, I'm confessing here, is that a lot of times the people that are teaching us have an agenda of how they make a living. And so it's really hard to give quality advice if it's coming from Wall Street that just wants your money. And that might not be the right thing for you, because maybe it's time for you to start a business. Maybe it's time for you to invest in your skill set. And investing into a retirement plan might be problematic because it doesn't help you build cash flow today. It doesn't help you understand how to make more money, or you haven't had financial education on how to keep more of the money that you make. And I think people skip those steps far too often. How do you make more money? Number one. How do you keep more of the money that you make without cutting back? And they go right to, how do I make money on my money? Yeah. And it becomes speculative. Well, I should do gold. I should do cryptocurrency. I should do real estate. I should do mutual funds. I should do a stock. And the thing is, before you've really invested in your investor DNA and discovered what type of investor are you? What are good investments for you? What can you do to create economic independence? This is such a huge factor, economic independence. Let's see if you can define it for us.
Economic independence is when you have more money coming in than expenses, right?
But that money's coming in on a regular basis from assets or from businesses that don't require your every single day involvement. It doesn't mean that you just set it and forget it and it always works out.
Right. A lot of people will say, I want to learn how to get passive income. Would you differentiate the two? Like, economic independence and having reoccurring funds coming in, but it's not necessarily passive, right? But that's just a term that floats around in the financial world a lot.
Right. I think that we've been lulled to sleep thinking that investments should be passive. We hand our money over and we make our money work for us. But the problem is, if that money isn't actually doing what we want it to do because it's taking on too much risk, there's too much volatility, there's too many fees, it's not creating cash flow, actually funding retirement plans can slow down our economic independence. I want people to be more active with their investments, than less.
Yeah.
Meaning, especially in the choice. Like if you're going to invest in real estate, be willing to say, that's not a good deal. That's not a good deal. That's, this might be a good deal. Let me investigate it further, rather than just handing it over to someone saying, well, they're the expert. I'll just trust them. Now, let me be really clear about this. There are extraordinarily intelligent, smart, brilliant people on Wall Street, but a lot of those are working for themselves or working for hedge funds. And there's a lot of people that are handing their money over, and it's not working hard enough for them. It's not doing enough for them. It's about accumulation, which is waiting for 30 years, compounding your interest and hoping that's going to take care of some future date. I want people to focus a lot more on how do you create cash flow. And Investor DNA would say, what category are you going to focus on? For some people, they're brilliant real estate investors. That's a good category for them. For others, it's a horrible idea. It's a train wreck. They're going to end up over leveraging and have negative cash flow and say yes to deals that weren't the right deals because they were just thinking that was going to be a good thing. Or people that get really hyped up because cryptos sound so good and Bitcoin, and they get in at the wrong times and they didn't really know what they were doing. We've got to get more educated. And I think we've kind of weakened society by saying, you can never figure this out. Just trust the experts. Well, a lot of experts are salespeople, not experts.
Yeah. It's like whoever is selling us on an idea or a product, we really have to look at where are they incentivized?
Right.
And those are questions that we can all ask people. It's hard to, navigate all of this, but when you begin to ask them those questions, you might get a more clear idea on how they're incentivized. And that's going to help you understand why they're pushing a product or a service to you.
Right. Follow the money. Yeah. Look at the compensation.
Absolutely.
Look, I had to stop selling life insurance in 2005 because it was really lucrative to sell it. And if I kept selling it, I have a bias towards overfunded whole life. People have to know that if they're watching the channel and listening to everything that we're talking about, because I like security, I like stability, but I don't think that's the end all be all. It's a storage facility for your money.
Yeah.
That you could then use that cash for other things. But what you use that for depends upon who you are. Where can you create cash flow? For me, right now, I think that's private businesses. For me, private businesses. Are there ones out there that can support Wealth Factory and our mission and vision that we could acquire, that gives us new ability, it gives us new infrastructure, gives us better reach, it gives us a good team. That's what I'm looking for, and I have to be picky. It's been a long time since I bought a business. It's been 6 years. It's hard for me to be patient. You know me. I'm not the most patient person.
You're a quick start.
So passive income, it's a degree. It's a kind of continuum. Completely passive, I don't know a lot of that exists, because a lot of times it's just money passing people by.
Yeah.
But making your investments more passive, meaning there's recurring revenue, it keeps coming in, but you still monitor it.
Yeah.
You still are responsible for the management of it, but you're not dealing with it moment to moment every single day. And rather than having an investment, you wait for 30 years to find out if it pays off, having that cash flow come along the way. So you get more active in the selection, and then you get more passive in the ongoing management. That's kind of the goal here.
Yeah. And what I'm hearing you say, passive doesn't mean that you're not tending to it. So I think sometimes passive for, even just in my knowledge and for other people, passive means I'm not being mindful about it. I just kind of set it and forget it, like you say sometimes. But there's more to it.
Right. And so mindful cash management versus budgeting. Budgeting is every dollar you're saying, okay, how much do I have that goes towards these types of things? How much do I have to go towards these types of things? It requires a lot of energy.
Totally.
And if someone is spending more than they make, they should go get advice from a different channel, and they should figure out how to budget, because you're going to be in a wreck. You're going in the wrong direction. What I'm wanting people to do is be mindful about the flow of their money and invest in themselves, and look to expand what they're making, look to make more, look to increase that income, and then increase their quality of life, but have an automatic percentage that's set aside. So as you make more money, it's not automatically spent. You're taking that percentage and setting it aside, and then you're just looking at the rest of the flow of your money and saying, and then economic independence is, how do you create enough cash flow to cover those expenses so that it's coming from your assets, not from your direct active income?
Yeah.
And so we all have to become better investors to do that. And it means that we can't just set it and forget it, invest early, often, and always, wait for it to work out, and trust the so-called experts. We have to utilize experts to increase our own knowledge so that we can be responsible and in the driver's seat of the decisions. So we utilize experts instead of rely on them. Being overly reliant is risky. Utilizing from the right voices and the people that have, done it before, or that really, they have a niche. So there's brilliant people that teach real estate. I'm not a big stock trading guy. I just don't think it creates enough value in the world. So there's people that can teach it, but they can't teach people how to govern their emotions. And so a lot of those things get sidetracked because of the emotions. So know who you are, know how you operate. And if you're not willing to be a little bit more active, that's why I think cash flow banking at cashflowbanking.com is helpful, because sure, you're not going to get a home run with that. But if you can get 4 or 5% with safety, with some security, with a level of guarantee once it's there, that's better than speculating in things you don't know and understand. And that volatility a lot of times gives people knots in their stomach. They're like, I just worked so hard for this and it just went down in value and I don't know why. And I had nothing to do with it. And that lack of control is actually creating far too much chaos. So the good news is you don't have to know everything that there is to know about finance. You have to know a few things, but know them really well, and life gets increasingly better.
Yeah. One of the things, going back to productive expenses, when you take $1 and you invest it into yourself, whether that's a course that you're taking, a book that you're reading, being coached by someone, sometimes it's obvious that when I put $1 into this, I'm getting more than $1 back. But sometimes I think productive expenses, it feels a bit ambiguous. Like, am I really learning from this course and applying it in a way that gets me more than $1 back? Do you have any thoughts on, how to start filtering through some of these expenses that we may originally perceive as productive, and then over time they are no longer
serve you, or they take too long to pay off? I think there's a lot of false starts out there. People go, okay, I'm going to invest in this course, I'm going to do the work, and then they find they didn't really enjoy the work, and they find that they had other things that grabbed their interest. So I think the most important thing that we can all do is define the win up front.
Yeah.
What's our win? How's this going to work? And my good friend Rich Christensen said, and then you create your safeguards. You create your guardrails is what he calls them. He's like, you're going to zigzag towards that goal, but you want to have guardrails so you don't get too far off course and end up crashing.
Yeah.
So I would call that course corrections along the way rather than a forced correction because you didn't pay attention. And so I just look at, for me, it's really around intellectual property is my number one investment. Looking to potentially acquire businesses would be a number 2 investment, but real estate's no longer part of my portfolio, but I think there's good people that can do that. It's just not where I want to put it. It was a distraction for me. I don't invest in the stock market. I've had no money in the stock market for a very long period of time. I haven't had to deal with that volatility. I haven't had to deal with, those major losses. It's just not my investor DNA. It might be for a few people, but far too many people are doing it without the knowledge.
Yeah.
There's plenty of opportunity out there. It's just that most people don't have cash on hand when the opportunities come, because rookie investors always stay invested. Pros sit in cash and then they capitalize when the time is right. The time is going to be right. There's so much opportunity coming everyone's way because it's a chaotic economic time.
Yeah.
And that chaos provides that opportunity for those that are prepared. So get access to cash. Focus on your cash flow and your cash management. Take all your assets that aren't producing cash flow and start looking at ways you can deploy it to create cash flow. And unfortunately, most people just want a really easy answer. I hand my money over and everything works out. But that hasn't worked out for far too many people. 95% of people are not economically independent at age 65. They still had a retirement plan, but the retirement plan didn't get them where they thought they wanted to go. And with every year that it's not there, there's a year that they lost time value of money. There's less time to make it work out.
Yeah.
And unfortunately, what's really the travesty is they sacrificed to get there.
Oh, yeah.
They missed out on experiences. They worked extra time. They're doing everything they could to help themselves and their family out, but they're stuck in the wrong game. The wrong game of deferral, of delay, of sacrifice, of scrimping, of budgeting, and of saving. And we lose who they are through value creation. The number one thing you can do is learn how to create more value and add more value to the world. That's what's going to bring about more cash flow. And then you just got to make sure you learn how to create that cash flow, how to make that money. Some people give their talents away for far too long for free. And there's the book Give and Take by Adam Grant that says those people that give too much without getting anything in return end up at the bottom. You got to be the givers that also make sure that you're getting paid for what you're giving. And if you can really discover that, I think that there's an extraordinary world out there, and we've got plenty of problems, Stova. Plenty of problems. And the bigger the problem that gets solved, the bigger the payoff. So where can you be part of being a problem solver rather than just pointing out problems? Where can you be part of the solution rather than just complaining? And where can you develop who you are, knowing that it's going to feel scary at times, but mistakes are part of the process. Try to make smaller mistakes rather than wait. And then the big mistake is that you never got started, that you never defined your win. You never knew what success meant to you, and you let society define it for you. So there's a lot to this. There'll be plenty more videos to talk about it. But, I think the important thing here is you create your morning ritual, right? You build out mindful cash management, knowing where there's a flow to your money. You know your different types of expenses. You know how to eliminate the destructive ones. You know how to increase the productive ones. And ultimately, you look for money that's missing from your life because you're paying too much to the government or too much to a financial institution. And you really start looking at the rules of the game. And those rules are cash flow. They're discovering your investor DNA. They're looking for ways that you can create recurring revenue, and that you're watching a video like this, which means that you're interested. Make sure you become committed to one thing that will add more cash to your life today. If you do that, that's momentum. Then take that momentum, invest it back into yourself, add more value, and the world starts to become a much better place.
Yes, I'm with you on that. I think one of the most beautiful things is when a person is fully alive. So when we begin to identify what value we can or add to the world around us, we become more fully self-expressed. And when I feel like that's a beautiful thing, you know, when you see just someone in their lane, loving what they do, enjoying it. And I agree with you. I think the world needs more people who are not putting their dreams in hibernation, but that they're fully self-expressed. And it's at that time when we can start solving the world's problems, or even just not even the world's problems, but addressing what's in our family or our local communities and contributing to the world in that way. So it's a hard process, but it's worth it in the long run.
All right. There isn't like a magic product out there. You know, if there were, we'd all just own it and be like, cool, super easy. That's why investor DNA and understanding the individual is key. Looking at a myriad of options so that you might see what makes the most sense. And disclaimer, I'm not a registered investment advisor. I did pass my Series 65 back in the day. I did pass my 6 and 63. I did get those licenses, and in 2005 decided it was time to write books and speak and do these things, and I didn't like the system of how I was compensated on those things, so I walked away from it. But I can definitely give a big picture view of what options are out there, what types of things could be done.
That's great. It seems like a great problem to have some extra cash on hand.
Yep.
So let's talk about what to do with that money. Jim wrote in and said he just inherited about $250,000. He has no current debt at the time, just a lot of cash.
Nice to be out of debt.
Absolutely.
Hope for that at age 70.
Yeah. Peace of mind, a lot of freedom that probably comes with that. He's 70 years of age. He's not really interested in another business. He also does trade the futures on a daily basis, just not with a good return on investment. So he's wondering what to do with his cash. A little bit of a hobby more than a expertise, it sounds like, on the trading. Yeah, possibly. Okay.
Well, let's look at the different options. There's no debt, so nothing to worry about there. At age 70, there's a couple options to consider that can create cash flow. Now, this isn't going to be substantial cash flow, but it could be consistent cash flow and very safe. Had a college roommate, helped him out when I met with his parents because they financed a down payment for him and his brother. And it was we doubled what they were getting on their CD, but we cut their cost by a third because getting a second mortgage as for a down payment avoids private mortgage insurance, but it's a higher interest rate than a first mortgage. So it was a really winning scenario because they went from earning 2.5 to 5. And these guys, rather than paying, 7.5%, 8%, they're only paying 5%. So they just cut the bank out as a middleman. Mm-hmm. They had the collateral of the property. So does he have anyone that's buying a home that's in his family that's fiscally responsible, could potentially buy that home and cash flow it?
Yeah,
become the bank.
Trust to pay him back.
That's complete collateral, right? Mm-hmm. Like that would be one example of what could be done here. It's not just your ordinary everyday example. A lot of people might think about there's dividend paying stocks in the stock market, but a lot of those dividends aren't really high dividends. Utilities typically pay dividends, right? Mm-hmm. But those aren't really high cash flowing types of scenarios. There's also things called immediate annuities. An immediate annuity means you put your money in and 30 days later, you can annuitize it to start kicking off monthly cash flow. Now, there's different types. There's variable annuities, which are actually just more expensive than most mutual funds. So I'm not a huge fan of them. The nice thing of annuitizing is you might be able to stabilize your cash flow, but limit what the growth is. But a lot of the times that's more of a indexed annuity that might do that, or a fixed annuity. The problem with fixed annuities right now is interest rates have been low for so long. These things are paying minuscule interest rates, right? Mm-hmm. But if you're willing to annuitize, there are kind of income-based immediate annuities that might give you, 6%. It's not the interest, it's how much interest and principal comes out from the $250,000 every year for the rest of Jim's life. So that's the most passive, don't think about it, a lot of safety. I don't love a lot of annuities because they just, you're locking your money into that payout once you do it. But at least you're not risking that you're going to run out. You're never going to outlive that. It's going to pay for the rest of your life. So that would be kind of an advantage there. Another thing that people consider, I mentioned on another video called a bond ladder. A bond ladder is, okay, the way bonds work is if we have interest rates, a bond is a debt instrument. So I could be lending money to the government. I could be lending money to a corporation.
I've heard about it at like school districts, right?
Yep.
Doing bonds.
Municipal bonds, even for like specific city projects, or, there's bond raising for certain communities. So yeah, you're lending money and they owe you that money at a specific interest rate. Now, if interest rates go up or down, it changes the value of your bond, right? So imagine if you go get a bond for 4% and interest rates go up to 5%. Well, if you want to sell your bond to get your money out of it, you're going to have to sell it for less because anyone else can go get a new one at 5%. So you have to sell it where it's yielding at least 5%, which means you actually hurt some of your principal, right? So volatility. Now, if interest rates go down, your bond value goes up because now people have to go, if they're investing new money in a new bond, it's paying a lower interest rate than what you've locked in. So you can sell it at a premium because someone's like, well, I could still get a better deal by paying more for your bond because it's older and it has a higher interest rate. Does that make sense?
Yeah, it does.
So it's an inverse relationship. But as bonds fluctuate, that could risk your capital, right? You could lose some of the principal. So a bond ladder might take a 1-year bond and a 3-year bond, because 3-year bonds are going to give you a little bit higher interest rate because you locked it up longer, maybe a 5-year and some 7 years. So you might have multiple bonds here. So if you decide to cash out or have them mature, you're not risking your principal, because now in 3 years you can get your full amount of money back and you just paid your interest during that time.
Got it.
But then some of your money is a little bit longer. So that's why it's a ladder, right? You kind of see the ladder phase here. They just have different maturities.
Okay.
Maturities when you can just get all your principal back.
Okay.
So you lent money to a corporation or to a government. It's really stable. Once again, interest rates have been really low. So as a business owner, that's awesome because you can borrow money really cheaply. As a retiree, not so awesome because you're not getting a high rate of return. Now, what you have to be really careful of is we know what investing is, right? We put money away and we hope that money grows over time. There's another thing to be aware of called disinvesting. So disinvesting is when we start taking our money out. But if we're taking our money out when the market's volatile, we might be taking it out during a time where the market goes down and it starts to chop away at our principal too much.
Yeah.
And then it disinvests and actually goes to zero. So there's a lot of studies saying if you take more than 4% out in the stock market, you're probably going to run out of money because there'll be a year it's down or 2 years it's down. And if you take the same amount of money, it starts to destroy or kind of take from that principal.
Does disinvesting apply when someone's wanting to cash out of their 401k?
If you're cashing out, not really. It's when you're taking systematic payments for income supplementation.
Got it. Okay.
Cashing out, you get whatever it's worth at that time. It's when you're spending it over time.
Got it.
Okay. So we've got invest, disinvest. We've got bond ladders. We've talked about immediate annuities. We've talked about financing something for someone that whether it's a family member that you feel is fiscally responsible, so that maybe they have to go to the bank and they're going to pay 5%. What if they paid you 5%?
Yeah.
You've got a piece of collateral behind it, which is the property. You could always refinance that, and that kind of stuff to pay them off.
What put in place with family? Like if you're loaning money to family, like what kind of agreement?
Contracts. A capital lease is the document that we would use.
Okay.
In something like that, because you want it to be in the position of the bank, and you're in a first position on the trust deed.
Yeah.
So they might be on title, but you're in first position. So if they ever default, you have that property as collateral, right? Yeah. So those are a few examples. There's some people that get into tax liens, which tax liens, you go buy someone that's past due on their property taxes, and they eventually have to pay that or lose the property. They lose the property, you get the property. They pay it, you're collecting by paying up front on what that property tax is. So. Yeah.
So I have one more question before we wrap this one up. So as someone inherits money, does that come into their life as just like income, or how is that taxed?
It depends on. So there's a thing called a step up in basis for capital gains. Let's say that someone paid $100,000 for an asset a stock, a piece of real estate, or business. At the time of their death, it's now worth $1 million.
Yep.
Okay. So right there, that's a $900,000 capital gain.
Yeah.
But under the law, when you die, there's a thing called step up in basis. So they treat it like you paid $1 million. So there's no tax on that because it was capital gains.
Okay.
Now, what if it was a 401k? Well, if it can go 100% tax-free to the spouse, 100% tax-free, okay? But if it goes to someone other than the spouse, you have two options. One is you pay the tax, so that tax would have to be paid.
Yeah.
Or two, there's something called a stretch IRA. So the stretch IRA would make it that you take it over time instead of paying tax in that given year. So it kind of slows down the tax. I don't love that because you're still not getting full access to the money. It's kind of tied up inside of a government plan, and taxes are fluctuating as time goes on. So it depends on how the asset is structured. If it's life insurance would be 100% tax-free. But where all of these things would have a potential issue is the estate tax. Now you have to, be at a decent amount of wealth to hit the estate tax. During my lifetime, I think the lowest it was like $675,000. So things over $675,000 got hit. Now it's over 10 million. So it's fluctuated all over the place. Wow. So an estate tax could still apply even if there was no income tax. So you've got potential estate taxes and you've got potential income taxes depending on it. But I think you just learned about the step up in basis if it was a capital gain asset.
What is CFB?
It's simply a system where you're overfunding cash value life insurance so that it ends up, beating a savings account 400 to 800% better, having protection from liability and bankruptcy, access to cash before 59.5, tax advantages along the way. And so essentially you have your own funding mechanism when there's good investments or things you've got the cash there.
Yeah. So cash flow banking is an alternative to a 401k, to a Roth IRA, and some of those other
to getting
accounts.
a loan at a bank it's kind of a whole system. So the first thing you can do is just let the money ride. You can just let it sit there. I've been doing that for the last several years now, just because I haven't liked, what's happening in the economy and I hadn't seen the right types of deals. And I've been just reinvesting back into my business. So that's one option. The things I've used my cash value for, I bought a business in 2014 with my cash value. I bought a lot of real estate from, I guess that was the year 2002 through 2007. I bought a lot of real estate with my cash value. I bought the very property that we're sitting in right here with my cash value because it was a highly desired property and I was able to move quicker than everybody else. So I got it and I got it at a slight discount. Didn't get really that much, although I think this has gone up a lot in value in the last couple of years.
Well, it brings a lot of value to your life.
I love it, and I'm not going to sell it. So I've used it for that. I use it for remnant rate. Remnant rate was putting New York Times and Wall Street Journal ads out for my first book, Killing Sacred Cows, putting a TV studio with it. So I've used it to invest in things that are aligned with my business and investments that make sense for me. So you have to figure out like what kind of investments you're going to do, and you kind of got to create what I would call a hurdle rate. What rate of return would those investments have to do to consider touching your cash value? If it's not going to do 10%, I don't want to touch my cash value. Now, my cash value has never done 10%. I think the best policy I have is just over 6%. Some are way down in the 4% range of what they're actually getting after expenses, but without taxes. So if I'm going to pull that out, typically it's going to be taxable. So I got to value the time that it takes for that transaction and the risk that comes along with it. So for me, if it's not going to get me 10%, I just don't want to mess with it. I like the stability and the security and having it there. And my main process with it is I want to make money on the buy. I want to be able to pull cash out of this and get something at a deep discount. Now, unfortunately, before I had my system set up or I tapped it out with other things, we had this house that my wife loved and wanted to buy. I've mentioned it before on videos, but I'll give the new updated part of the story.
Okay.
I thought we'd get it for basically a third less than what they were asking for. And I was right.
Discount.
I was right. But I had a letter from a bank saying that we were pre-approved. Another family came in and bought it for cash.
Oh.
So I got it down to 1.6. It started at 2.2 and they bought it for 1.5, which is what I was going for. It just sold recently for 2.55.
Wow.
So that was a make money on the buy almost because they had access to cash. So that's, if you could buy something at cash flows from day one, or you can buy a business that's in distress, or a property that's the seller's in distress and needs cash quickly, being able to access that cash quickly, I think, is one of the major advantages of having this.
Yeah.
Right. And I've used it for hard money lending, where I'd use my cash value to secure something, charge someone a bunch until they got bank financing, and then I'd get paid back at a pretty good interest rate. So
if someone has a large sum of money in their policy, and they also have some high interest credit card debt or a student loan that they want to get rid of, cost of money on some of these credit cards is 17 to 24%.
We've seen 29% in one of the Ask the Millionaires questions.
I think so. I think that's the highest that I've seen. So would it be wise to take money out of the cash flow banking policy, pay off that debt, because that would be greater than a 10% return?
100%. Yep. You nailed it. So you could just kind of let it. Right. Look, I actually used my cash value once to pay off an American Express. So we had done this major campaign for killing sacred cows, and I put it on the credit card, and basically it took longer to pay off than I expected with the promotion. And so I had just paid it off with my cash value, so I didn't have to pay the interest rate on the American Express.
Yeah.
Because it was it was like $70,000 or something like that. So yeah, that's a great example. Paying off loans, perfect. I wouldn't touch it unless it's safe and secure and cash flowing. Otherwise, I just kind of let it ride. And you got to figure out your investor DNA. What kind of investments are going to be right for you? Is it business acquisition? Is it real estate? Is it creating intellectual property-based business that's for yourself? Is it getting the right financial team around you so you can save on tax? There's all sorts of different investments that are out there, but I'm not a fan of just handing my money over and being like, cool, this is a fund. Like, I don't care if it's a real estate fund or a stock fund or a bond fund or I just don't do funds because I am too far removed from the outcomes.
Luis says, is it a smart idea to withdraw the total $86,000 in a retirement plan that I have to fund a whole life banking policy? He has $72,000 from an IRA and $14,000 in a Roth IRA. I was laid off due to COVID on May 1st and still unemployed, but my wife is doing well, so we're doing well. But since there's no penalty, it seems like the right thing to do based on what I understand from your teachings. So the question here, should Luis withdraw his money from his Roth and his IRA to fund a whole life banking policy?
Well, if there's no gains in the Roth, he might be able to get that money out without not only no penalty, but no tax consequence potentially. So that's something to look into. The actual traditional IRA that's pre-tax and it's tax deferred, even though there might not be a penalty due to the COVID rules, there's still going to be tax. And so with no income coming in from him, I want people to be really careful about committing to a monthly amount going to cash flow banking. So cash flow banking, for those that haven't watched the videos, is an overfunded cash value policy where you use something called PUA, paid up additions, where you're putting money in and it's being deposited with the least amount of commission on that. And it gets dividends if it typically dividends above the guaranteed interest rate. And once those are paid, they are guaranteed and they're available. And so you could use that for other investments that maybe come up or paying off high interest rate loans. I mean, those kind of things. And even though there's tax advantages, you don't have the restrictions that you have with IRAs. The problem is this isn't really a clean cut. You can't just roll it over with no tax into this plan because it's one type of asset, which is a government qualified plan, to a private contract. And so, for example, if you had a piece of real estate that you were selling, Stolba, you could roll it over to another like-kind exchange piece of real estate, right? There's 1031s and 1035s. One refers to real estate. The other one refers to insurance. So you can go from insurance contract to insurance contract without having to pay tax on your gains. It just rolls into the other thing. But if you're going from a non-similar asset, kind of apples to oranges here, there would be taxation, even though there's no penalty. And if you funded all of that into a policy up front, you might have what's called a MEC, a modified endowment contract, which actually limits a lot of your tax advantages. So it isn't really clean to be like, oh, I'm just going to put this from this IRA over to this cash flow banking overfunded whole life policy, because that policy is probably still going to have premium payments due unless you do have paid up in the first year. And then all of a sudden you lose some of the tax benefits and it's not that much of a tax difference than the IRA at that point. So there's some things to weigh out.
Yeah. So when someone is establishing a whole life banking policy, there needs to be a consideration around the stability of their life and their finances, right? Are
Totally.
they able to make the payment for a year, 2, 3? How many years is it?
You want to like really be thinking like you're going to be really comfortable, like ideally 7 years, but
Okay.
but you'll be okay if you've been funding a few years and there's months that you aren't going to pay anything into it because you do have some flexibility depending on the riders that you have on the policy.
Yeah.
You know, where you could do a automatic policy loan, or you could do, you know, a number of things where if you don't make that premium but you've been overfunding, you're not going to like lose the policy. But the downside of a whole life policy that's overfunded versus a savings account is savings account, you can just stop funding it at any time. There's no consequence because there's no life insurance attached to it. With these plans, they have a baseline cost for the insurance. And yeah, when it's designed properly, you might be at break even at 4 or 5 years, and then you're going to be way ahead of a savings account at 10 years and 15 years and 20 years, and you have access to the cash along the way. But you kind of have that commitment. And so I used to say, well, if you could commit to 2 years, it's suffice, but that's still a little bit risky. I like a little bit longer.
Okay.
Good question.
And with his wife, it sounds like his wife is doing well, therefore they're doing well, like he said. But when looking at a whole life banking policy, or I guess not whole life banking policy, but the IRAs and the Roth IRAs, like pulling that out, it might be a good idea if income is lower than it has been for them in the past, right?
Because that might be a lower tax. Good
tax
point.
bracket. Okay. So that might be
Good
something
point.
to consider, even if you're doing well, if you're not making as much money as in your
Because you have
past.
marginal brackets, right? So marginal bracket is the first X amount of money that you make in a year. Let's say I'm just generalizing, is 20 grand is only going to be taxed at 10%. But then from 20 grand to 50 grand, it's taxed at 15%. And so what happens is you have lower tax brackets if you have lower income. But as you make more income, they don't raise all of your income to the higher tax bracket, only the later dollars. So you have to see, if you cash this out, is it going to change your marginal tax rate?
Yeah.
What tax rate will there be on that cash out? So that's a really good point. And the other question I would really have is, what is going on inside of the investments inside of the IRA? We know they're probably not cash flowing because most of these are accumulation based and waiting for, you know, retirement age or 30 years, whichever one's longer, I guess, or, you know. And then the second piece is, with no cash flow, what is the risk management to this? I mean, we've had very volatile markets. It's gone down, it's come back up, and we have a high unemployment. We have a lot of money that's being added to the economy. It's a very chaotic time from a financial standpoint, especially for investing in things we don't know. So I like to say, how do you create downside protection? How can you focus on creating cash flow from it? Secondarily, and do you have enough liquidity? Like, it's important that you have at least 3 months of living expenses set aside before you move from a term policy to an overfunded whole life. And then when you have that, you can start filtering that into the cash value that's above that. Now, ideally, I'd love to see people with 2 years of savings set aside in cash value to cover expenses if something, you know, crazy happened, like COVID was, you know, is pretty crazy. And, you know, we're dealing with a pandemic. So having that kind of staying power is super helpful. I personally don't have any IRAs because I just don't trust someone that's $28 trillion in debt that they're not going to raise the taxes to cover that. And I don't really want to partner with the government any more than I'm already partnered with them, that they get a percentage of my income. And there's sales tax and consumption tax, and there's property taxes, and there's self-employment taxes, and there's, you know, VAT taxes if you're in Europe, and there's, you know, estate taxes. So there's already enough tax that I don't really trust deferral into a future that's unknown, uncertain, but we do know that they are deep in debt, right? And they're going to have to eventually do something about it, which is either ruin our monetary system or tax us more heavily. I'm not sure which one's going to happen first, but probably get taxed more heavily is what I would bank on. So that's why I don't have money in there. I did have money in those plans back in the day, and I just took the 10% penalty, cashed it out. That was my preference. But I think it's, you know, I think when you have $100,000, you can navigate the tax world a little bit better.
Yeah.
You know, when you've got millions in there, it's a little harder to just if you cash that out, you're in the top tax bracket for the majority of that money. So now what if the government starts raising tax brackets and you're sitting on that money and you're like, do I just let it defer into a higher tax rate? Because from 1944 to 1981, the tax bracket was above 50%. You know, and right now we're at like 37.5, and there's talk about it maybe going up, but we've got the Senate and we've got Congress and, you know, or the House, and we've got, you know, a president. And so there's a lot of things happening there. So I think considering where would you invest it?
Yes.
If beyond just a whole life policy, and what returns are you getting there? Because a whole life policy in today's low interest rate environment, maybe it's going to get 4% after 5-7 years. Maybe it gets my highest one was like 6.17%, but that's without having to worry about taxes. That's net of all the fees that are involved with the life insurance. So I look at that as a great place to store my money.
Yeah.
And then I look to capitalize with that money when opportunities are there. And there's going to be a lot of opportunities.
Yes. Yeah. We have some other videos where you've talked about that with Walker. And so maybe we can link to those about seizing new opportunities when you are sitting in cash. But I think it's really important to consider liquidity in times like this. And so that was a good reminder there. I
remember the first time I heard the word liquidity, Stolba. I was 19. I didn't know what the hell they were talking about. They're selling me some, variable universal life insurance product talking about liquidity. And I was like, liquidity? Like 19, I didn't even know what that was. Now I'm obviously very intimately familiar with liquidity, especially when I didn't have it in 2008. You become very familiar with what it is.
Yes.
Yeah.
The reason why I was so excited about uncovering this, like who does not want to be economically independent in 10 years?
Right.
I don't want to
maybe
think
sooner.
Yeah, sooner would be great. But 10 years is not that long of a time. Just think of what your life could look like in 10 years if we accomplish this. Let's do it. Seriously, let's invite this into our lives. Abundance. Here we go. Alex's question. Let's get there. He says, my question is hard and easy at the same time. I see that you put a video out each week, and I finished your book, Killing Sacred Cows, and I've read Rich Dad, Poor Dad. Being that what you both said make more sense to me than most, how do I learn cash flow? Great question, Alex. And the 5 levers you talk about. I'm not the best reader, so Audible is the way to go. That's fantastic. And
I'm not the best listener, so what do you do for me? As many people have told me on the comments, Stelba. Stop interrupting.
You're getting better. I don't think you're that bad.
Well, we're comparing me to when we first started, so it's like there was only room for improvement.
That's true.
That's why it's great to have my wife around. She just grabs my knee.
Okay.
Gently, like as a reminder, like shut the F up. People are trying to talk. You're interrupting everybody. Oh.
Stop it.
Yeah.
I don't.
Is that insecurity or is that just I'm excited about life?
It could be both. You never know. I can't determine your motive. Only you can.
I have so much that I love to say.
I have so much that I know you need to hear.
That's why I'm married, right? Because my wife's more like quiet and introverted, and we'll go for an hour drive. I just carry the conversation, and she's totally cool with it.
She has one earbud in on the side that you can't see.
My God, lately she talks so much, right? When you guys are around, you guys just jabber. I'm like, I don't even get to talk.
Yeah,
I just sit there and listen to you two.
With Carrie.
All right.
We have a lot in common. Okay.
You both have to deal with me.
Former teachers that have to deal with Gunderson on a daily basis. Okay, let's get to Alex's question here. We're derailing ourselves, but it's fun. Okay, so he wants to know, let's start there. How do I learn cash flow? Okay. And he wants to know more about the 5 levers we talk about.
Okay, we'll start with cash flow, then the levers. So really the 3 main asset categories for cash flow.
Okay, number
businesses.
1. Business.
Right. Small business, especially, privately held businesses that you might be able to acquire that can create cash flow, create it immediately. Okay. Second is real estate. That's pretty popular. A lot of people know real estate. Yeah. But we look at those 2 categories. There's so many subcategories, different types of businesses, brick and mortar versus digital, like, employee run, businesses versus, stock, shareholder run. There's so much to look at there. Same with real estate. Is it going to be residential, commercial? Is it fix and flip? Is it buy and hold? But we're talking cash flow, so I'm talking more like residential, buy and hold type of thing.
Yeah.
And then I feel like intellectual property gets discounted a lot of times, but it's really important, and it's an asset class. It's something that you can create recurring revenue. Sometimes people on YouTube get super pissed when you have an author offering a book, as we've seen. Like accusing people of only having wealth because they wrote books. I'm like, well, did they say that to Steinbeck? Did they say that to Hemingway? Yeah. I get it. I understand the frustrating thing of someone saying, I can show you how to do what I did. And, and it's just a big hyped up marketing session. I understand the frustration.
Yeah.
But ultimately, that intellectual property, we're in a how-to world. There's lots of people that are being trained to learn things online and figure that out. And so if people have that expertise to help people improve their lives, I think that's another cash flowing asset. Now there's other things that people could do to create cash flow. It's just not really what I would focus on. Stocks, bonds, sure. There's all sorts of different types of investments, and we talk about it in my book, 5-Day Weekend. We have whole chapters, because Nick, my co-author, has done so many different types of investments, and he has things called share lording strategies, and you name it. But there's plenty of ways to do it. But I want to focus on businesses and real estate is kind of the big two.
Okay.
Now, economic independence comes from these 5 levers. And so
that's what we're going for. 10 years or less.
10 years or less. And look, it takes effort and work, but it's work that can have recurring revenue and payoff.
So I have a question for you. You said businesses are one of the number one ways to improve cash flow.
Yeah.
What if someone doesn't have the desire, they don't believe they have the skill set to start a business? If you don't want to be a business owner, how can you invite cash flow into your life?
Well, sitting in this very seat one morning on a Sunday morning, my wife says, we need to create a curriculum for homeschool that's on the things that they don't learn in school. Money, marketing,
social skills,
emotional intelligence, social skills. That's a brilliant idea. So I make a little post. What was it? 460 comments.
It was a lot.
A lot of those were mine responding, but a lot of comments.
Yeah.
And then I was like, I don't have capacity to deal with this to make it the quality that I'd want to. So I put it on the back burner. We talked about it a couple times, talked to the other team at Wealth Factory. And then you came and you said, I think I have a unique skill set in that, and I'd like to do something. Well, that's something that we might be able to do a joint venture with you on that you can create recurring revenue from.
Right.
And being entrepreneurial, finding ways that you can create revenue inside of an organization that can be recurring is a way that you can create economic independence.
Yeah.
So you don't have to own the business, but you could work within the business. And that would be one example.
Yeah.
You could own a house and Airbnb part of it.
Yeah.
You could
sell your clothes on Poshmark.
you could rent out your car on Turo. I mean, there's things you could do. Those are a little bit active, but ultimately it does require effort, and people want it to be pretty effortless. They want to set it and forget it. They want to put it into a retirement plan, wait for 30 years and it's all going to pay off. I mean, this is a weird notion to me.
Yeah.
We're not adding value. We're just buying something.
It's just automatic.
Thinking it's going to go up in the future, but why is it going to go up? Why will it stay up? Why will it be more valuable? Why is our money going to be more valuable? It's things that we haven't really been taught to question.
Yeah.
And I'm here to help people question that so they can say, maybe I'm giving away my power. Maybe I'm giving away my money. Maybe I'm giving away my life because I work so hard for this money and I'm waiting for someday to be better. And it's been a broken promise. So there are ways to do it, but it requires effort.
Yeah.
It requires upfront thinking.
Yeah. And some resiliency. And I feel like business in a lot of ways feel similar to relationships, where you're in a relationship. It kind of
take some notes on this.
Well,
it's a pain in the ass.
It's a mirror into your life. You have fears that come up, pains that come up, and it's reflective of that. I think when you start a business, the same thing happens. I didn't realize I was fearful. I never realized that I felt incapable, or business has that same kind of dynamic with us. So
we either be an entrepreneur or an entrepreneur, or it's going to be a pretty tough life.
Yep. I can see that.
Or you can marry into it, win it, or
I'm not taking chances on that.
What else could we do? You could marry into it. You could win the lottery, or you can inherit it.
Clearinghouse could come to your doorstep.
But that's a lot of work. It's a lot of work.
And it's more fun to create your own business. I think. Be more creative. Okay. So
5 levers.
Yep. Hopping into the 5 levers. So let's just do a quick rundown.
Let me see how much you know of this. This is a quiz. What's lever number 1, Stelva?
I'm not
First
good
lever.
at this
First
stuff.
lever.
No.
Keep more of what you make.
Yes.
Become more efficient. Plug the leaks.
I need to just have a sticky note on my thing here.
You got to. It's about saving on tax, saving on interest, saving on insurance, saving on non-performing investment fees. It's about the big things, not just coupon clipping, but the big things that make the big difference. The second thing is to engineer wealth. You got to know what your monthly expenses are that sustain your living, and then reverse engineer and say, what are the steps that are going to help you get there? So it's building out the plan, build the foundational pieces, then the safety and security pieces, and then the growth pieces third.
Yeah.
If you skip the first 2 steps, you take unnecessary risk and you might have to start all over again.
Get yourself in a pinch.
Right? Playing Legend of Zelda from the old NES with my youngest son. And so you can get these little potions that when your heart containers are low, you can take the potion, it fills them back up. So you got to have 2, and you can get the red one, which gives you twice that you can do that. So foundation, then safety. Now you're going to be able to be a stronger character.
Someone
and
is going to relate so hard to that example. It went over my head.
Insane,
I've never played the game.
I'll have Roman explain it for a few hours to you today. Don't worry about it. So,
as he's quoting The Office.
Yeah. Oh god, he's hilarious. So then the third step is to accelerate investment income. It's to become a cash flow investor. If you have stagnant, lazy assets that aren't kicking off cash flow for you, you turn those into cash flow so they help you get economically independent. And the fourth thing is to scale revenue. Entrepreneurial, figure out ways you can contribute to the bottom line of a business and get a percentage, or as a business owner, scale and grow that business by doing what you do best, delegating the rest, and getting crystal clear on what you can do to add more value, reach more people, or more deeply impact those people, and finally make it count. Enjoy your life along the way. Build the life you love. Manage your energy. Do the things that you don't exhaust yourself or run yourself into the ground, and then all of a sudden you have less to give. That's what happens to too many people. They get in the hustle, the grind, the whatever it is, and it's a game that's really not worth winning if they get stuck in that. So keep cash, plug the leaks, right? Engineer wealth. Accelerate investment income, scale business revenue, and make it count. Invest back into yourself. And that's going to help you with this framework to become economically independent and get there a lot faster. Most people don't get there because they're not training themselves on creating cash flow. They're training themselves on being patient, on waiting, on deferring, on delaying, on scrimping, on saving, on cutting, on budgeting. I mean, it's just like this nonsense that we've been just indoctrinated with to destroy the enjoyment of life along the way in the name of living a better life one day, someday. And because we care about people and because we want to do good, then that kind of guilt and shame rises above and says, hey, you got to do this, otherwise you're being reckless. And that starts to stifle creativity, ability, and value. It's a game of value creation, vision bigger than our problems, finding the hidden capital, which is your mental and relationship capital, and then loving on people. That's the deal.
That's a big one. I like the phrase that when you're describing the 5 levers, you said, do what you do best and delegate the rest.
Did I say that? I like that.
Yeah. That had a little rhythm to it. Do what you do best and delegate the rest.
You know that little rhythm I got into?
Yep.
That's the play rhythm that we're going to do at that one spot.
Okay. I'm feeling it. I'm feeling it.
So remind me to watch that as I'm writing that part.
Okay. Okay. We have one more thing in here from Alex's question. Are you all done with the 5 levers? Anything else you want to say there?
No, okay. There's other videos where we're going pretty deep on that. So check them out. Yeah.
He says, I want to change my life in 10 years or sooner. I'm not scared of hard work. I just don't want to work myself to death. And I think this is a common, maybe not even a fear, but something that people think about. I want to start a business, but I don't want it to overrun my life. I don't want it to take away from the time that I spend with my family and friends. So how do I utilize business as a tool to get economically independent without it overtaking my time and my life?
So this is so simple, but this is it. This is big.
Okay.
You determine what the win is up front. Then you create the rules of how you're going to play.
Okay.
When you're in business, you get to create the rules. People think the rules are being available all the time. You know my rule. I don't want to be available. I want to be accessible. So the right people can get a hold of me, but not quickly, because I'm going to live life on my terms and my schedule, and then support from there.
Yeah.
So what do I do with email?
I check it for you.
No, I don't do email. I mean, I send some emails out sometimes, but I'm barely on it because there's too many uninvited guests on my email inbox, right? And what's nice with YouTube comments, it's not urgent. People aren't like,
get back to me within 24 hours.
Right. Yeah. And they're not giving me major projects to do either. So I like having that filter. So I just determined that rule. Like when I first was in business, I'd meet anytime, anywhere. And then eventually I was like, oh, I don't meet past 6 o'clock. And hey, I'm taking Fridays to study. And my old clients had a problem with that. But anyone that knew, they didn't care. Any of the new people that came in. So you create the rules.
Right.
Like, and I started to improve my life. I started to tell my wife, I'm like, okay, only one night a week do I work late. And so I got strategic about the other nights. And I made sure to, and then eventually it's like, I don't work late any nights. Right. So you kind of determine what works for you.
Yeah.
So I don't take my computer into my bedroom because I don't want to be tempted to get on, any type of comments, or I don't want to be writing or working on a project or anything like that. So it stays downstairs. Like you just create the rules up front. and people will work by those rules.
Yeah.
You get to determine it. I don't know why we think that everybody else gets to determine that. It's been indoctrinated.
It's our
been
life.
It's been like it's permeated at a cellular level. So what's your game worth winning?
Yeah.
Right? Like my game worth winning is to be an artist. I want to work on the play. I want to do these videos. I want to write. I want to really make a major impact so that by the time I'm dead, 1 billion people have had this impact their hearts in a positive way. That they feel better about themselves. Like I'm tired of these other guys saying people are stupid and wrong and idiots. Like we're like
No.
we are human. Making mistakes is part of the process.
Right.
If we stop villainizing the mistakes and start learning from them,
Yeah.
we can extract the lesson without having the experience become who we are.
Absolutely.
Too many people identify themselves by their mistakes, but like the mistakes got you here. So were they as bad as you thought?
No.
I don't know.
You're not stupid if you make a mistake. We all
You're
make
human.
mistakes. Yeah, we're human. It's a part of the human experience. And we just take it as data. What do I learn from it, like you said? And how do I
Right.
move forward from it?
So as I look at this, what we're really trying to do is create enough cash flow from assets to cover expenses. When you do that, all your active income can build more assets. So that's super helpful. And as we look at the 5 levers, it's a good framework. And as you look to start a business or refine your existing business, it's time to begin to establish your business rules. What are your rules of operation? How do you want to do business? And you get strategic. Like I was like, I want to go to Italy for 2 months. I didn't know how to do it, but we created the game.
Yeah.
You started how many days before that?
Maybe 7.
7. And I'm like, I'm out for a few months. And how often did we talk while I was gone?
Maybe 2 or 3 times.
Right. Because I created the rules. It's like, this is the rules we're going to play by. Do that work for you? If not, then you don't have to work with me. Right. So
I was still around when you came back, so that was a good sign.
right. Yeah. You were around, and so was AA Ron, because he had the same deal. He came around at the same time. I'm like, well, I'm off.
Yeah.
Enjoy. But everybody got to mature and grow up. Right. It's kind of like our going off to college kind of thing for the firm, So,
One of the things when you say, what are the structures of your business and your life, looking at your calendar, it seems really obvious, but we're protective of your mornings.
Right.
We don't share those.
That's where I write best.
Yeah.
This morning I did my row and recite because I'm working on the memorization of the play. Right. I wrote some outlines for some YouTube videos.
Yeah.
And I reviewed some personal notes around family constitution and, made some celery juice for the family, some metal detox smoothies for the family, some lemon water, and even a latte for my wife. I didn't have caffeine today.
Yeah.
You proud of me?
Props to you. You're
I will
drinking
tomorrow.
tea.
Yeah. Right now I'm drinking some
Elderberry.
Yeah, no, I finished that. Now I'm drinking like a protein shake. I don't like protein shakes. It's like dates and,
Yeah.
yeah.
We're going to navigate and help you to discover what are the different things that you can do to lower those interest payments so even if you make the exact same payment, you pay it off in a shorter period of time so that you keep more of the money that you make. So you're not making the institutions as rich so that you could be wealthier. All right, Tim, let's dive into this. Tim Carden here with me. He's the money nerd that can go in depth on these kind of things. I always look at credit cards as kind of the easiest thing here.
Yeah.
Because when I was moving years ago, I called to cancel my cable, which included like internet, and we actually still had a landline because my wife really believes that the kids are going to need a landline one day in an emergency. So great. So we had all these kind of things. It was like 170 some bucks a month. So I called to cancel. But they moved me to the retention department, and by the end of the call, I'd saved $70 a month, even though I was still going to cancel it, because it wasn't that I was overpaying in my mind. It was just simply that I was moving and was going to get a different service in a different location. So that really kind of put a light bulb on for me, and I was like, I wonder what it would be like doing this with credit cards. So I just called the credit card company, and the first person I called really has no authority, no power to do anything. So I just said, hey, do you have any deals? Do you have any departments I could talk to about balance transfers? But the thing that really gets them is if you say you want to cancel,
Yep.
right? Then they move you to retention, and they immediately think you can't afford it, or that there's someone out there with a better deal. And so they're very easily going to move that interest rate down because there's no collateral against a credit card typically. So that's probably the lowest hanging fruit.
Absolutely, because they're, a lot of them, when we first get our credit cards are 20, 24%, somewhere in that range. There's a lot of room in there. And so if they think somebody's offering you a lower interest rate, better deal, they're going to move very quickly.
Any tips on what you would say?
I usually like to call them same thing, right? I've got these offers that are coming to me in the mail. Looks like a much better offer, but since for simplicity's sake, I'd like to stay with you guys. If you can match or beat their offer.
That's
right?
a great one.
Yeah, and that one seems to work almost every single
But
time.
you've got to get on the phone with the right person.
Yeah, the first
And it's
person you
typically
talk
not
to.
the first person that answers.
Yeah, they're a telemarketer. They're just, nobody gives them their authority, right? The authority is going to come from the second department, second person you talk to, for sure.
Right, you want to get in that retention
Exactly,
department.
right?
Other places where you could renegotiate loans, a streamlined refinance. Let's say you've been paying your mortgage on time. Let's say you've got some equity inside of that, and interest rates are lower now than when you originally got the loan. So you might not have to do a full refinance. The problem with the full refinance is there's a lot of fees.
Yep.
And it's a bit of work.
It's
right?
a lot of work.
So you got to look at, with all the fees, how long before you actually break even on the better interest rate. You do a full appraisal. You have all these loans that you have to go through. But if you stay with the same company, there are times, and this isn't every time by any means, I don't know, I don't have like the stats, but it's probably like 1 in 3, 1 in 4. So it's not overly common, but it's worth the phone call.
Exactly.
Now, we've had crazy situations happen when people have made these phone calls.
Absolutely.
My buddy Kevin, he called to do this, and the second mortgage company was the same company as the first mortgage. They offered him a deal that if he paid 10 cents on the dollar, they would wipe out the second mortgage. This wasn't a loan modification. It was simply a company that was in need of cash and in trouble and knew that they didn't have very good collateral because the market had gone down at that time.
Yeah, and we'll see that a lot. And it'll change how often they'll do streamlined refinances with market conditions, right?
Right.
Banks will loosen things up and tighten things up accordingly when they have to. And so never hurts to make the phone call, because now we're talking like a third to a tenth of the cost to get the loan done. The process is like a week to get a loan modification.
A few pages instead of
absolutely.
You know,
so
killing a tree.
absolutely.
So what is the language you would use there? And is the word streamline something that they're common and familiar with, or is that something that I just know this technical term?
Streamline refinance is a common industry term. They should know exactly what you're talking about. And once again, kind of the same strategy with the credit card company. They know, I mean, if we're driving up the freeway here in I-15, how many billboards are there that just say, if your mortgage is above this percent, refinance now, right? So they know we're getting hit with lower rates and better terms constantly.
Right.
And so they don't want to lose that business either.
Right, so streamline refinance would be on a mortgage, negotiating better interest rates on a credit card. What other kind of loans, like, is there anything you can do on a student loan?
Yeah, there's a bunch of different places you can not necessarily renegotiate. It's usually a refinance.
Yeah.
They are very stringent. I haven't had anyone actually lower an interest rate for me, or anyone for a client, anything like that on a student loan. They don't really renegotiate very well with student loans.
Right.
But it usually comes down to a refinance on a student loan in order to prove that position.
Now, I've seen loan modifications where someone is far behind on their payments.
Yes.
There's not much equity in the property. They've had some type of hardship. This isn't usually an easy process either.
No.
There's a process of proving it out. There's a process of being late on your payment. It's already hit your credit score, so it's not going to work every time. But loan modifications could be lowering the payment on a mortgage, for example.
Absolutely. Like the HARP program is one of the most common, the most recent iteration of that with the housing collapse that happened. And they allowed people that really were behind, really had some hard case situations to renegotiate the loan right in the middle of the stream. But you had to turn in full financial packages, all kinds of stuff. It was just almost as hard as doing a full refinance would have been. But for those that needed it, it worked out. We found about a third of the people that applied for HARP actually got a HARP modification.
Now, have you seen, because I've seen where people like want the fees up front, they're like a private company that help with loan modification. How many times does a loan modification happen versus not happen? And is it worth paying the money up front? And do you have to pay it up front?
No, I wouldn't really pay them up front. Same thing with credit repair. If somebody says, just pay me up front and then I'll go get the work done, a lot of times the work doesn't follow the payment. And they might make a real true effort at it, but you're paying for something that you're not necessarily getting. So I don't really like the pay up front unless there's some sort of written guarantee that they'll take care of that for you and it'll happen.
Okay. So other places and other loans that you can see where we can negotiate better interest rates?
You know, I've seen us negotiate interest rates on pretty much every type of loan. It just depends, except for the student loans. That's the one that's been the least successful.
Your financial circumstance and situation is a big part of that, right?
Yep, absolutely.
And what your financial reporting is, or if you had a certain hardship.
Yep.
So really maybe what we pivot to is just refinancing in general.
Yeah, and using a refinance for a modification too, or a renegotiation. So that's happened very successfully, where the current company says, nope, we can't bend, no exception, no anything. So we actually get an offer sheet for a refinance and say, well, they're going to offer me this. And then all of a sudden the bank's like, oh, well, never mind, we can help you out.
Well, here's where a refinance can make a lot of sense. Let's say you have a paid off car. You could refinance that car
and pay off a higher interest rate loan like a credit card or a line of credit or a business loan. Because a lot of times car loans can be like 1.9, 2.9, really low interest rates because there's the car's collateral. And if you can refinance a car, not a lot of people think about that, right? We think about refinancing a home, but that's just a more preferred loan. And by the way, that loan is an installment loan that if you pay it on time actually helps and boosts your credit score.
Absolutely. So that's a great thing to do if you got high interest rate credit cards and other things. Just refinance a car at a much lower rate. You just saved 18% in interest cost. And
one that I'm hesitant to mention, but it's important, I think that you have to be the right type of saver, you have to have the right infrastructure, but you could refinance a home, which is potentially tax deductible on that interest, and typically really low, and you can lengthen the loan so you can keep your payment down low, and you could refinance anything from cars to credit cards, or if you have enough equity, you could just gobble your whole student loan up inside of there. And now all of a sudden, you've got a better payment structure. But the problem with this is if you just go back and get big loans because you go get a motorcycle, go get another car, go get a boat, and all of a sudden you're financing these things with the freed up payment, that didn't really help out in building wealth and moving you along in life. But if you take that savings and you just set up a separate account, and you automatically save that difference into that account, so you start building up that liquidity, which gives you staying power. Build up that liquidity, which allows you to handle and navigate different turbulent times within your life. I think that's where it becomes especially valuable.
It's really valuable, if, like you said, if they've got the discipline to pretend like they're still making the old payment, but they're going to make it to themselves now, so Parkinson's law doesn't steal the wealth from them.
Right, and Parkinson's law is if you have an increase in income, expenses rise to meet or exceed that increase within 3 to 6 months. Now that's my rendition of how I'd say it. I know you know the history behind Parkinson's law and maybe a more accurate definition.
Yeah, so C. Northcote Parkinson did a study of the English Navy. He gave 2 different groups a job to do and a time frame to do the job in. 2 different time frames, same job. They both took the exact amount of time. And that was his first iteration. The second iteration had to do with the size of government agencies and corporations that they would add to payroll by a certain percentage every single year, regardless of need or growth. Once they received a critical mass is what he called it. He almost got killed for that one because a bunch of people got laid off when those reports hit, and so he got a lot of death threats. And then he brought it into personal finance, and your definition was very accurate. It was basically what you said, increase or excess of cash flow. If there's not a purpose designated for it, your expenses will rise to meet or exceed it.
Right, this is part of why you'd see this economic catalyst type programs where they might say, oh, you're going to get a refund, a tax rebate, tax refund. It's not the problem that people are getting a refund and that's really creating the spur in the economy. It's that with Parkinson's law, people spend that 2, 3, 3.5 times over because like, oh, I'll do that because the refund's coming in. But then they'll categorize that, put it aside, oh, I'll do this because the refund's coming in, and they spend more than they actually have. So Parkinson's law is one of the scary things if you're going to go refinance something, free up cash, and then not have a plan or a strategy with that freed up cash. So look, people that are a train wreck, people that absolutely spend more than they make, paying extra to a loan, shortening loans might be the very best thing they do, with the caveat that that could put them at risk of default if they're spending more than they make, right? Because what kind of frustrates me and concerns me at the same time is that people used to get car loans, they might be 36 months, and maybe 48 months, maybe 60 months, maybe that 5-year loan. Now it's like 84 months.
84 months.
People are just getting long because now they can buy more vehicle even though they can't truly afford it. We become a payment-based society versus a purchase on price-based society. And I want you to be really calculated and careful when you go about refinancing. So first, see if you can renegotiate. Can you get your existing interest rates lower, right? Streamline refinance, which isn't a full refinance, or negotiating a better interest rate with an existing loan because you have comparative or competitive deals. That could be very useful. And then just refinancing a home could be good, refinancing a car, or looking at any type of loan where you're paying a lower interest rate with the new loan versus the old loan, so that with the same payment, you're either shaving that time off or you freed up cash to build up your savings, your liquidity, invest it back into yourself. We're really looking at how can this personal finance be personal to you, giving you enough information that you can be informed and make the right choices and decisions.
Absolutely, and if they've got that discipline, if you have the discipline to really do the refinance, free up the cash flow, and then use that cash flow for savings and growth, that can be a very, very valuable tool. We've used that with great success for many, many people.
Stop making the problem worse. How much longer do you want to stay in the losing game before the market completely collapses? Look, the experts tell you stay the course and that corrections are normal, which is great advice if you want to lose money over the next 4 months and really probably the next 26 months. You don't have to invest in the stock market to get ahead. Now more than ever, it's time to be smart. Stop panicking and protect yourself before you lose a huge chunk of your investments. Almost all articles written about the financial markets are telling the same story to investors. Stay the course. You're in it for the long haul. If you're young, you have time to recover. Don't panic. Blah, blah, blah. I was reading an article that had this terrible advice and quotes from financial advisors in it. Here's the first quote. Stay calm. Corrections are normal. Really, these are normal? Wise investors do not move with the herds. Your investing strategy should not change. That was Michelle Perry Higgins. Really? Is that good advice? Or is this really advice at all? I'll show you why this is a terrible idea and what to do about it, but let me just show you some other things. Roger Ma, another financial advisor, says, keep focused not on external events, but your financial goals and when you need to accomplish them. Does the market give a shit about your goals? Does it? This seems like advocating taking no responsibility and ignoring what's going on. Wow. I mean, kind of sounds narcissistic to a certain degree, if you know what I'm saying. Yeah, these were written before trading was suspended a third time to prevent a market free fall. Let me quote Roger Ma again. He also wanted people to ask what they need to do to achieve their retirement goals. How about not lose 10% in a week or 7% in a day? You know, he also said that someone who is 20 has 40 or 50 years to retirement to ride out the ups and downs. This is dangerous advice that will lead to more risk, less return, and is a huge part of the problem. My advice has been the opposite for quite some time. For example, one of Wealth Factory's clients, Justin Nault, gave me permission to share his story of having trailing stop losses. Now, we have all sorts of investment advisors that work in the Wealth Factory accredited network. And so they helped him put a stop loss, okay, a trailing stop loss. And what that does, and this is exactly what he said, I had all of my triggers set to 15%. So our advice is, at what point when the market goes down do you start to panic? At what point when the market goes down does your mindset start to follow? So he put 15% trailing stops, and they all activated, of course. He put, of course, haha, which really saved my ass. I'm quoting him. All my triggers activated between March 9th and 12th. Okay, he said, since my position sold, the Dow and S&P are both down an additional 11 to 12% overall at the time he emailed me. That's what he believes, okay? But he said, that's just in the market in general. Here's what he said. Some of his positions would have absolutely collapsed thanks to the coronavirus. For instance, his Tesla stock sold at $652 per share, and it's currently sitting at $465. He said his Shopify shares sold at $422, and they were currently sitting at $334. He said, I mean, I can go on and on with examples, man. It would have been a bloodbath without the trailing stops. Visa, Apple, Exxon, Chevron, etc. He said he had grabbed quite a few positions. All right, so let's break this down for you. Number one, thinking you can recover from losses doesn't account for companies that go under, right? Or for time value of money, which is also called opportunity cost. Let me say what that is. If you lose, you miss out on the time of that growth, and even a small loss, right? A small amount can add up to a bunch due to what it would have become. Okay, more on that in a bit. Ultimately, this type of ignorance must be accounted for, or you're going to take unnecessary risk, and those losses are compounded over time. Let me illustrate this, okay? Point one, let's go through market fluctuations. The first financial services firm I ever encountered convinced me to put my money in the stock market. I was 18 years old at the time. One illustration I was given showed a continuous 12% annual return, which they said was conservative. Now, why in the hell did they do this 12%? Because they claimed in 1998 that the stock market had averaged 12% since 1929, okay? Now, they were really about this you're in it for the long haul myth. Why that's a myth is, well, let's illustrate it. They showed me ending up with a fat nest egg at retirement age with a relatively low monthly investment of like $70 a month. The company also showed me what it would end up with if I had a continuous 18% rate of return, which is illegal, by the way. But because in the 90s, people thought the market was just always going to go up, they thought it would be fine. Now, in 2020, this seems absolutely ridiculous. But at the time, the 90s had inflated everyone's expectations. As an 18-year-old, I didn't know any better. They had to show me that on a separate calculator to show 18% because the software that the company put out wouldn't show those illustrations, right? The industry actually has laws to prevent financial services firms from legally illustrating more than the hypothetical 12% annual return, which is still ridiculous and inflated. Because when people look at the 90s, okay, the 90s, I get why they thought that. But if we look at from 2000 till, before the downturn of 2020, it's been more like 6% appreciation. So aside from the illegal tactics, their approach was fundamentally flawed. Financial service companies overlook that if we insert just one negative 12% annual return into the equation, in the time frame of that investment, the entire computation is thrown off literally by hundreds of thousands of dollars. It gets even worse when we replace that continuous 12% with the actual historical performance of the stock market. I'm going to do all this for you, okay? So why do retirement planners fail to consider and illustrate the possibility of negative returns? Well, the answer is twofold. First, most of them were not trained to incorporate negative returns into their calculations and may not realize how dramatic the effects can be. Second, even the ones who do realize this concept, well, they don't want to lose a sale by showing dismal numbers. Optimism, even unrealistic optimism, brings in more customers, all right? So because most of us labor under false information and all these financial myths, we get excited about the positive numbers and tend to think these calculations actually represent reality. So let's look at the numbers. In my book, Killing Sacred Cows, which I'll make sure you get a copy of, no charge, on page 74, I actually put together a chart. Now, this notion of, Roger Ma saying, look, if you're 20, you've got 40, 50 years before retirement, so you've got time. He's not taking into account what's called opportunity cost. If we insert one negative 12% annual return over a 30-year period, the entire forecast is thrown off by so much money. So, Roger, good luck with planning on retirement needs in that scenario. So let's use $100,000, and you can follow along with interest calculators or future value calculators. I downloaded one for free on my phone to kind of validate this that was in the book. If you had $100,000 at 12% over 30 years with no tax and no fees, it grows to $2,996,000. That's pretty cool. That sounds pretty exciting. But what if you had a 12% loss in year 10 instead of a 12% gain? It turns out that you only end up with $2,354,000. Now that's still a good amount of money, but that one negative year was a $642,000 loss. Yeah. $642,000 less. Now, let's use the actual return of the S&P 500 after 3 down years from 2000 to 2003, but we're including the best decade ever of the 90s. With that, the money ends up being more like $1,250,000. That's quite a bit different than $2,996,000, right? It's more than 50% off course. Look, here's the big point here. It doesn't matter if you lost that 12% in year 1, year 10, year 15, or year 30, if we're talking about a lump sum $100,000 investment, all of the time it still has a $642,000 impact. You may be asking why? Well, sure, in the first year, you'd only lose $12,000, right? That doesn't seem so bad. But now let's take $88,000 and run it at 12% for 29 years. $88,000 only grows to $2,354,000 because you don't have the gains on the $12,000 over that 29 years. That's crazy. So it doesn't matter if it's year 1, year 10, year 15, or year 30 because of something called opportunity cost and compound interest. There's compounded costs or compounded effects to the losses. So the second piece here, are we more committed to emotions or economics? See, if the market goes down and your mindset follows, well, now it's time to reconsider a few things. Did you do what Justin did and have a trailing stop loss on your account so you don't have to rely on a broker or say, I guess I'll just ride this out because the only way you lose is when you cash out? Well, how do you feel when you're not in control of the outcome of your investment income? I don't like it. I don't want to put my hopes and dreams on a market I don't control. Do you know why the market will go up or why it will go down? Do you know what your exit strategy is? You're your greatest asset. So if this is causing you stress, it's going to make you more vulnerable to getting sick, unfortunately. So the question is, are you focused on the solution or stuck in the problem? All right, the third piece. What can you do to improve your finances right now? What can you do to get guaranteed returns? Now, there's not guaranteed returns in the stock market. I also find it very interesting. Like when people say, oh, future, return or past returns are not an indicator of future results. I kind of feel like if you know much about football, I feel like Bill Belichick and the New England Patriots, they get rid of players who are no longer functional. But the Washington Redskins pick up those bad stocks or bad players and go, we'll overpay for them. That's what people are doing right now, thinking the market's low and that they're buying on sale. It's not on sale yet. It's not even close. There's still more to go. So what can you do to improve your finances? Let's talk about that. Refinance. Interest rates are low. Businesses impacted and can get longer loans with greater rates from the SBA. Might be difficult, but they're now doing 30-year loans at 2.75 to 3.5% interest. That's really cheap. It's time for you to get access to cash, even if you don't need it immediately, so you can be prepared for worst-case scenarios where this might go on longer than expected. I would start considering cashflowbanking.com over the stock market. Cash flow banking from the last 20 years for me has done 5.32%. The stock market has done around 6%. But I'm not losing money right now. And we're not including the negative 2020. So now my cash flow banking accounts, without the risk, without the stress, are outperforming the stock market. Less volatility with a similar net return. Plus, I have access to that cash when everything's on sale down the road to capitalize and buy. Plus, there's tax benefits without locking your money away, like retirement plans. Go to cashflowbanking.com to learn more. You can build up cash to buy in the near future. That's going to be a critical piece. This may not be possible for everyone if you're already in cash crunches. But if it is, look, there's still going to be plenty of deals down the road if you could build up liquidity. But if you think now's the deal, but you're not sure, don't speculate. Too many people are calling and texting and asking if now is the time to buy. If you have to ask me, the answer is pretty simple. It's not. You don't know. Now's the time to focus on cash flow, on economic independence more than ever. Economic independence where you're focused on cash flow and assets that help support your income. It's time to protect your assets. It's time to build up your reserves. The next piece, it's time to develop your investment philosophy. Maybe even reconsider everything that you're doing. Discover your investor DNA, which is your core values, your core competencies and where you have real knowledge, your core drivers and where you want to pay your attention. It's time to focus instead of diversify. Diversification is diversification in this type of market. It just means everything's getting a haircut. Everything's losing rather than just, a few things. But what if you focused on real deals, things that you knew and understand? Maybe you could buy a business that's at a deep discount. Not maybe in the stock market, maybe a private business. Maybe you wait for a while and you're a real estate investor and you're going to see more deals pop up as cash flows tough. But look, I'd be careful. We saw Carl Icahn just shorted the commercial real estate market, which means he thinks it's going to go down. You've got to determine what a good investment is for you and what a bad investment is for you. And if you don't know, stay safe, stay liquid, pay off loans, build up cash flow. It's time to create a vision beyond this crisis. It's time to focus on cash flow again that far too many people have neglected. It's time to develop ways to increase your skill sets. Maybe it's time to learn marketing. Maybe read, watch, and learn, right? What you can do to monetize your skills, right? Find the things that motivate you while the stakes are higher than normal and traveling is limited because you have more time at home. Grab the mega kit, wealthfactory.com/mega kit. Text 44222 if that's easier and put wealthier in the subject line. Why? Because there's Killing Sacred Cows, my book, so you can help navigate the financial myths that are going to be everywhere during these times, where you can learn about what would the Rockefellers do so you don't have to participate in the downside. And then the next piece is it's time to learn from the big mistakes. Do you have enough liquidity so that you have staying power? See, saving and investing are two very different things. Investing locks money away. It's volatile. It's hopefully earning returns, but maybe not in this market. Saving is available. And when you have enough savings, you have staying power. You can have a peace of mind fund, and a war chest, so you can handle these kind of crazy, erratic times. Maybe it's time to stop funding your retirement accounts and take care of your liquidity. The reality, it's time to stop making the problem worse. How much longer do you want to stay in a losing game before the market collapses? The experts tell you to stay the course and that corrections are normal, which is great advice if you want to lose money for the next 4 months. The investing advice from people that make their money selling the stock market may not be in your best interest, and it's time to take back control of your money.
Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.